What's going on, traders? I'm your host, Joe White, and welcome back to Inside Trading. Today, we're covering the market from February 9th through the 13th. This past week was a reminder that the market is not done fighting inflation. Stocks rallied early in the week, then inflation data hit, bond yields spiked, tech sold off, oil climbed, crypto swung violently, and suddenly the idea of early rate cuts started to fade. This past week wasn't a crash, but it was a wake up call. On this episode, we're breaking down the major indexes, CPI and what it really means, bond yields and rate cut probabilities, oil and energy strength, crypto volatility, market psychology, and what traders should prepare for next week. Let's get into it. This week, the Dow Jones was defensive but fragile. The Dow Jones Industrial Average started the week steady. Industrial names and defensive stocks helped stabilize early action. But once CPI printed hotter than expected, even the Dow couldn't escape volatility. Midweek, we saw the Dow drop after inflation data. Then buyers stepped in near support levels. However, we still saw a slightly negative week closing down around 1%. The Dow continues to show relative strength compared to tech-heavy indexes, but it's not immune to rate pressure. The S&P 500 traded like a battleground. Every dip was met with buyers, every rally stalled quickly. This is classic uncertainty trading. Bulls betting inflation will cool soon, and bears betting rate cuts will be delayed. Technically, the S&P 500 is still above major support levels, but momentum slowed and also finished the week down around 1%. The index is no longer in easy rally mode. The Nasdaq became very sensitive to the idea that we might not see a rate cut in March. Out of all three major indices, the Nasdaq was most reactive. When bond yields ticked higher, tech immediately sold off, resulting in weekly losses of almost 2%. Why? Because growth stocks are extremely sensitive to interest rates. Higher yields reduce the present value of future earnings. The hotter CPI print forced traders to reprice valuations, and the Nasdaq felt it first. Despite selling pressure, dip buyers showed up aggressively. That tells us sentiment is cautious, not bearish. The big news this week was the Consumer Price Index report. Inflation came in higher than expected at 2.4%, slightly above the Fed's target of 2%. Core CPI, which strips out food and energy, remains sticky around 2.5%. Why does it matter? Because the Federal Reserve has been clear. They need sustained disinflation before cutting rates. This report did not give the Fed confidence. The immediate impact was bond yields rose, rate cut probabilities dropped, causing growth stocks to sell off. Markets have been pricing in early rate cuts. That narrative took a hit this week, and expectations shifted. This week's CPI report shows us that inflation isn't surging again, but it's not cooling fast enough. That's dangerous for markets because if inflation stalls above target, the Fed could keep rates higher for longer. That's the scenario investors are starting to consider. The bond market reacted to the Consumer Price Index also. The 10-year Treasury yield ticked higher after the CPI report. Why does it matter? Because the 10-year yield influences mortgage rates, impacts corporate borrowing costs, and drives equity valuations. When bond yields rise, growth stocks typically fall, and this is exactly what we saw midweek. Oil prices moved higher this week. Supply concerns and geopolitical tensions added upward pressure. This resulted in energy stocks being among the strongest performers. And here's why that matters. If oil keeps rising, inflation pressure returns, that creates a feedback loop. Higher oil prices leads to higher inflation, and higher inflation leads to higher bond yields, and higher bond yields puts pressure on tech. Energy strength may signal rotation happening under the surface and is something I will be watching very closely next week. Let's switch over to cryptocurrencies. Crypto traded like a high beta tech stock this week. Bitcoin saw sharp swings following CPI news, Ethereum, Solana, and XRP followed. Crypto is still trading on liquidity expectations. If rate cuts are delayed, volatility will probably continue. But interestingly, major support levels held. That suggests crypto's speculative nature hasn't vanished, just cooled. Now let's cover this week's sell-off. The midweek drop wasn't random, it was mechanical. The hot CPI led to bond yields spiking, causing algorithms to sell sensitive assets. Then stop losses triggered, producing increased volatility. Then buyers stepped in near technical levels. This is a healthy correction dynamic, not panic, but it does show how fragile sentiment is. This week's selling also highlighted the Sell America trend. This trend is part of a 2026 investment trend driven by policy uncertainty and tariffs, where investors are reducing exposure to U.S. equities, bonds, and the U.S. dollar. It involves hedging, diversifying into global markets, and shifting to assets like gold. This trend focuses on trimming overweight assets rather than a complete exit. Personally, I still believe in American assets. At this point, I own only American stocks, bonds, and crypto in my portfolio. As long as the US dollar continues to be the world's reserve currency, my belief that American assets are the safest to own is not going to change. Right now, we're in a psychological standoff between buyers and sellers. Bulls believe the economy is resilient, earnings are stabilizing, and inflation will trend down. Bears believe inflation is sticky, rate cuts will be delayed, and valuations are stretched or overinflated. Neither side has full control of the market, and that creates chop. This is currently not a trend market, it's a data-driven market where every CPI print, every jobs report, every earnings report, and every Fed comment matters. So keep a lookout for news. Now let's discuss what I'm watching for next week. My focus will be on bond yields, especially the 10-year, Fed commentary on Monday, February 16th for guidance on interest rate changes in March, technical support levels of the S&P 500, oil's price continuation upward, crypto holding key zones. If yields stabilize or if yields keep rising, markets could react quickly, and I expect more pressure on overall market growth. The previous week reminded traders of one truth. Inflation is still the driver of the market. The market wants rate cuts, but the data doesn't necessarily show justification for it. This is the kind of environment where discipline wins. The market isn't broken, but it is recalibrating, and recalibration creates opportunity. This has been the weekly recap for February 9th through the 13th. Thanks for sticking around till the end. If you like this breakdown, hit like, subscribe, and comment on what you will be watching next week. I'm your host, Joe White, and until next time, remember to plan for how you act or act for how you plan. See you in the markets.
This video is for educational purposes only and does not constitute as financial advice. The hosts and guests may hold positions in stocks discussed. Opinions and strategies expressed are not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any financial decisions.